Hello guys, good evening and welcome to this video on basic Forex terminologies. We're going to skim through a few terminologies. I want you to follow through. If you do not understand at any point, you can go back, you can pause, you can rewind, you can start from the beginning, whatever. Just make sure you get every single concept one after the other, because these are the things that you'd see recurring during the periods of your trading career. Number one, currency pair. Every currency is in pairs. For example, GBP USD. This is Great British Pound. This is United States dollar. You will never see any trade that is just one particular currency pair. You can't come to your chart now and see GBP and say trade. No, it has to be paired with something. USD has to be paired with something else. CHF has to be paired with something else. CAD has to be paired with something else. JPY, US dollar, Canadian dollar, US dollar, Swiss franc, US dollar, Japanese yen. Every single currency comes in pairs. You can only trade in pairs because it is one against the other. This is the only thing that differentiates the forex market from stock, because in stock exchange in those days you can only make money in one direction. So if the market is appreciating, you are in profit. If it's depreciating, you are in loss. But in the forex market, it's quite different, because two currencies are paired against each other. It means when, for example, it means when this one is appreciating, this one is depreciating. So you can make profits both whether the market is going up or coming down. Do we understand? So if GBP is appreciating, the market will be going up. If USD is appreciating, the market will be coming down. Do you understand? So whether it's going up or it's coming down, you can make money, and that is the advantage of currency pairs. This is, some people don't even know the importance, but this is quite important, because unlike the stock market, you can make money in any direction. Whether the market is going up or the market is coming down, you are in profit if you know what to trade. The second is base and quote. In one of the videos, I already explained this, the base and the quote. The base is the first currency in a pair. For example, now you have GBP USD. This is the base and this is the quote. Now the base, the value of the base is always 1. The value of the quote is how much of this you would need to buy one of this. For example, let me use something that we understand. USD NGN, United States dollar, Nigerian naira. 1 is equals to 1,185. The meaning is, if you have $1, you have 1,185 naira. Same thing here. If you have 1 Great British Pound, maybe this will be 1.0135 or so. Do we understand? So the essence of this is for you to know that every time you see, I didn't say that, so let me say it. For every time you see a pair, GBP USD, USD NGN, the base is always 1. The base is always 1. The quote is how much of this currency you will need to buy the base. How much of this you will need to buy the base. So you can also even see NGN USD. So it means for every 1 naira, how much USD can you buy? Maybe 0.0000, whatever it is. So the base is always 1. And then the quote is how much of this do you need to buy the base. The third point is the leverage. The leverage is when your broker allows you to take a higher position. For example, if you have $100, the leverage means you might be able to take a position that is as much as $1,000, $1,500. Now, while this is a very good thing, it's also bad for those who do not know how to trade, because if they're allowing you to take as much as and profit of as much as $1,000 account on $100 account, it means if it goes against you, you will blow your account. So the bottom line is learn how to trade, and you are going to be safe. Because if you don't learn how to trade, you would become like every other retail trader in the market that keeps dashing the market makers plenty money. Those guys have so much money and they still keep collecting. Very stingy people. The fourth concept is the bid and the ask price. When you think about this, think about any other day you just randomly stroll to the market. The bid price is the maximum price, the highest price that a buyer is willing to pay, while the ask price is the lowest price that a seller is willing to sell. The idea is basic. I saw a mango in the market, and then the guy tells me he will sell it for 1,000, and I said, guy, I know if you buy 1,000, and I tell him the highest I can pay is 500, and the guy tells me, Oga, the lowest what if you sell this thing now 700. I either leave it and go, or I buy it at its price. So the ask is this price, because it is telling me this is the lowest I can go. I know if you go less than this. Then the bid is this price, because I'm telling him, Oga, now the highest what if you pay be this. You get? So it's quite basic. Forex trading is just like every other business. Like I said in one of the first videos that I sent, Forex trading is just like every other business. It is buying and selling. The only difference is that in the Forex market, you are buying currencies and you are selling currencies. Number 5, exchange rate. Exchange rate is quite basic. It is the current price or the current value of one currency against another. So if you're asking what's the exchange rate of USD NGN, it is simple. 1 is equals to 1,185. This is the current exchange rate. So if you have $1, you already know that it's worth 1,185. If you have this, you already know it's worth $1. That is the exchange rate. That's the 5th concept. The 6th concept, margin. The margin is the amount of money that you must deposit with your broker in order to open a position. 7, pip. The pip is actually the point in percentage. The point in percentage. In short, it's the smallest move in price. Smallest move in price. We have 2 types of pips. Number 1, every other currency. And every other currency, the pip is the 4th number after the decimal. So if you have 1.01353, let's say for Euro USD, 1, 2, 3, 4. So the pip starts from here, and so let's say it's moved from 1.01350 to 1.01353. It is 3 pips basically. If it moves from 1.300 to 1.10353, it is 53 pips, because it's from 00 to 53. Do you understand? So when you're calculating the pip for every other currency, you start from the 4th number after the decimal. So if you have 1.01354, you count 1, 2, 3, 4. This becomes the first number for your calculation of your pips. Or let's say it's 50, whatever it is. Yeah. But when it comes to JPY pairs, that's Japanese yen. Japanese yen is the 2nd category. Japanese yen, it is the 2nd number after the decimal. So if you have 134.851 for Japanese yen, this is your pip. This is where it starts from. So like I said, in other currency pairs, let me explain that part, because Some people are wondering why I'm drawing or why I'm putting another number after the pip. Since the pip is called the smallest movement in price, why is there another number? The other number is called a fraction or a fraction. I don't know. I call it a fraction. I don't know what they call it. Yeah, so if you have 0.13561, 1, 2, 3, 4, this is your pip. This is a tenth of a pip. Well, so if it moves from 0.13521 to this, it is 40 pips. Why? Because it moves from 0.13521 to 0.13561, so it is 40 pips. For if it's JPY pairs, it is 124.513 maybe to 124.525. It's from 13 to 25. So 13 to 25 is how many pips? 12 pips. I hope we understand that. I just hope we understand it. Yep. So the very next concept that we're going to consider is the lot size. The lot size. The lot size is the size of a it depends on a particular market and asset. A lot represents a specific number of units and assets. For those that have taken trades before, you realize that lot size plays. You will see some currencies will allow you to start from 0.001, then up and up and up till 1 lot, till 10 lots, till one, as many lots as possible, 50 lots, 5 lots, depending on your account size and then the positions you want to open. So for example, maybe you have $100. If you open 0.001, maybe you'd see that the thing is the trade will open at 0.15 or so, and then it will be moving small. But if you go to go and open one lot size with 100, you might see that the thing might open from 1.00 or maybe minus 0.51, and then it will be moving at a very sporadic rate. The idea of lot size is this: when you open a trade with a particular lot size, per pip movement, it will move according to that lot size. Let me look for a way to explain it. I have a very massive loaf of bread, and I want to see how fast the bread will be finished. Let's say someone like me, I don't like eating bread, and so I eat half slice of bread at a time, and then I eat it continuously. The bread will last for like 1 week. But somebody like maybe my friend that loves bread so much, he eats 12 slices at the same time. In less than 1 day, he would have finished it. So the idea is, I have $100. I want to get to $200. If I use a smaller lot size, maybe 0.001, it is going to be very slow. Maybe it will take me 2 months to change, or 5 months or 10 months to change $100 to $200. But somebody who uses one lot size or 0.5 might get there in 1 week or 2 weeks. The only problem is this: if the market goes against this person, he can lose his account in a few days. But if the market keeps going against me, no matter how many times, it will be so hard for me to lose my account. Why? Because I'm using a small lot size. So the market going against me will not affect me that much, because I did not take a very large position in the market. So lot size is like your position in the market. So there's so much money. Your lot size determines how much of that money you want to take at a particular point in time. But I would advise you to always use a moderate lot size. Don't always be going for the fat chunk. You have only $1 account, you're using 2 lot size, you will blow that account in a week. The next idea or the next concept is bullish and bearish. I said it in one of the video. Bullish is used to describe when the market is having a positive outlook or the market is on an upward trend. Bearish means the market is having a negative outlook or the market is on a downward trend. So when you come to the market and you see that it's all sell candles, maybe just one small buy candle here, and then it's sell, this is a bearish market. If you come and what you have is buy, maybe one small sell here, and then it still keeps going up, this is a bullish market. The next concept is the spread. The spread is the difference between the bid and the ask price. That's the difference between the bid and the ask price. It's like the highest price a buyer is willing to pay, while asking price is the lowest price the seller is willing to pay, to accept. You get? So we've talked about the bid and the ask. So a spread is actually the difference between the bid and the ask. So for example, that thing that they said they want to sell for 1,000, and I told the guy, me, I cannot buy it anything more than 500. The guy said, oh, me 700, I will sell. Nothing more, nothing less. The spread will now be the difference between the price I am willing to buy and the price the seller is willing to sell. So my spread here is going to be 200. Do we understand? It's the difference between the price, the highest price that the buyer is willing to pay, and the lowest price that the seller is willing to go. In other words, many of you have realized it before. If you have ever taken a trade, you realize that maybe you have $100 and then you take a position, maybe 0.01 lots. Then as immediately the position open, you realize that it's on minus 0.51 cents. And you're wondering, but I just entered this position, why is it in minus? It is because of the spread. Where you entered is like $0. That's where it's supposed to start from, and either move up or move down. But because of the spread, it's open for you around minus 0.51. And so if you are going, if it's going up in profit, it will come all the way to 0 and then go up. If you keep losing, it will keep going down until it gets to -2, -5, -10, and so on and so forth. So that's what the concept of the spread. So next time you open a position and you realize it starts in loss, it just opens in minus something. That's the idea. It's the spread. The next is resistance and support. I've talked about this so many times, so I'm not going to stay too much on this. Resistance is a particular level where price gets to and then change direction downwards, while a support is a particular level a price gets to and then change direction upwards. That's the summary. That is the summary of what a resistance and a support is. The very next concept, a quote. Okay, I think I've explained the quote when I was explaining the base and initially. So I'll just go directly to a position. So your position in the market is whether you are buying or you are selling. Remember one of the videos I said the 3 things you can do in the market is either you buy or you sell or you wait. That's what your position is. Waiting is not like an official Forex position. It's just a disposition where if you come to the market and you don't see a buy or a sell opportunity, you don't do anything. That's what wait is about. If you do not see a buy position, you do not see a sell position, you have to wait to avoid jumping into the market and living in loss. Anytime you look at the market and you don't see what you recognize, leave it alone and do not trade to be on the safer side. We have open and close position. A open position is a position that is still open. A closed position is a position that is still closed, as the name implies. So when you take a trade, maybe you have $100 and you take 3 trades. Maybe one is 20 plus $25. The second one is maybe minus 12. The third one is plus $7. So maybe because this and this are in profit, you close it. So 25 plus 7 is that will be plus 32. So your close position now becomes $32. Your open position is this minus 12. Maybe you're waiting for it to become positive. So this becomes your open, this becomes your close because you've closed it. So any position you close is your close position. Any position that is still running is an open position. Until you close a position, it is not profit or loss yet. So even if you come and you see minus 50, if you have not closed it, it's still an open position and you cannot regard it as a loss yet until you close it. Profit or loss is only when you close. The reason why I'm saying this is because some people can have profit of like $70. Close it, they will not close because they are waiting for it to get to 100. And if they now leave it and go somewhere, they will now come back and see that it's already minus 15. So the $70 was not your own because you didn't close it. It only becomes your own when you close it. I hope you get that. The next one is candlesticks. Like we all know already, candlestick is this visual representation of price. Your sell candle and your buy candle. In case you hear this, if you don't know yet, you know today now. So when they say candle, you will not be thinking of the one that you buy and use when there's no light. Do we understand? Now there are a few. There's top entry order. This is or we call it stop loss. A stop loss and a take profit. A stop loss, for example, if I enter a trade, I have a $100 account. I enter a trade, my target is $5 and I'm willing to lose $2. I will put my stop loss at a place where once it gets to minus $2, it will close. So my balance will now be minus $98. And I'll also put my take profit in a place where when it gets to plus $5, it will close. So my balance will be $105. The idea of stop loss and take profit is to ensure that when you are not available to monitor your trade, it will be on automated or autopilot. Let's call it autopilot. You understand? So even if you are not there, once it gets to your stop loss, it will close, and then at minus 98. So your capital is preserved. Only what you are willing to lose would go. Then if it gets to your take profit too, it closes at this. The reason is because many times if you are not attentive, it will get way past your profit margin, and because you are not there, it will now go back into loss. So anytime you know you are busy, always put your take profit at the position where you know the price will get to, and then also put your stop loss just in case it doesn't get there. It gets to the stop loss and it closes. Do you understand? Never forget this too. It's hard to lose your account when you are used to using stop loss and take profits. I hope you will not forget this, because many people forget these basic things, and that's why you hear somebody saying, I lost 100,000, 500,000 US dollar. And you're wondering how. So there is also market execution. Market execution is when you want to enter a trade immediately. For example, you see a position, you want to buy the pair at 1.0851. When you go, you just enter market execution directly. If the price is already here, you use market execution. But if the price is not here yet, maybe the price is in 1.0857 and it's coming down, and you want to put a sell, you can use you can actually use, let me show you this, so that I want to show this one. I think this one you have to see it. Yes. So if you want to take a trade, no, let me use my MT4. The MT5, the interface is very confusing, really confusing for me sometimes. Like, I can use it, it's just that I cannot teach with it. So this is the plus to take trades. You will notice market execution here. This is market execution. Market execution means you want to enter a trade at the current market price. But if you do not want to enter the current market price, if the price is still in front, let's say you want to buy at a higher price, you will not use market execution. What you use is buy stop. Buy stop means, for example, the market is here now, and I feel like the market should buy when it gets to this point. So I would put a buy stop at this point. I'll enter the price here. And so once the market gets to this point, it will pick my trade and begin to buy. The same thing with a sell stop. A sell stop means maybe the market is here and I feel like the market will start selling when it gets here. Sorry, the market is below and I feel like it will start selling when it gets here. I'll use a sell stop and then it will sell downwards. There's also a sell limit order and buy limit order. In the case of buy stop, I said I predicted that when it gets to this point, it will begin to buy. Buy limit means it's buying now, but when it gets to a particular point, it will begin to sell from that point. That's what a buy limit is. For a sell limit, same thing. For sell stop, it means when it gets to, maybe it's coming, when it gets to this point, to begin to sell. But sell limit means it has actually been buying, and when it gets to a particular, it has actually been selling, but when it gets to a particular point, it will begin to buy. I hope we understand that. I just hope I did not confuse anybody. Please just watch it as many times as you possibly can and try and understand it. The next term is appreciation. As easy as it is, appreciation means it is going up. Basically, depreciation means it's coming down. So if the price is currently at 1.0851 and it has been going up, it has gone to 2, 3, 4 until it has gone to 1.0895, it is appreciating. If it goes to 1.0731 and is going down, it is depreciating. Simple. Then we have risk management and money management. Risk management and money management is also quite easy. Risk and money. Basically, what this thing is saying is, do not be a daredevil. Don't be a daredevil. Enter the market with only what you are willing to lose. If you have $100 and what you want to lose is $2 per trade, don't go and use 1 lot size or 0.5 lot size. Use 0.01. Use a small lot size where the market will have to make many movements. It has to move for long before it reaches the $2 you are willing to lose. When you become an expert, of course, you can decide to enter with a higher lot size, but make sure it is only high probability trades. There are trades that are called high probability trades. Trades that you can swear that no matter what happens, this trade will not go wrong. High probability trade. But there are some other trades that are low probability. You cannot say for sure that this trade is going to do well. Those ones, use small lot size. If you have a high probability trade, you can use a high lot size. I hope we get that. Volatility is the measure of speed and magnitude of price movements. Things like gold. Gold is very volatile. For those that don't know what this is the name of gold. This is silver. In the Forex market, in case you see this is gold. Gold is very volatile. If you enter a gold trade, it can turn $100 to $200 in the same day. But it can also turn $100 to $0 in the same day. It is very volatile. It is very fast. So you have to know what you are doing when you are trading volatile things. Same thing with NASDAQ. Same thing with US 30. All of these things are very volatile pairs. You have to realize they are volatile and trade them with care. Do we understand? A portfolio is all the financial securities that you're holding in your trading account. So your trading portfolio is everything you are holding in your trading account. If you are trading currency pairs, indices, stocks, everything at the same time, that is your trading portfolio. Your balance is the amount that you have in your account after you trade. So, for example, if your trade was $100 and then you made $10 profit, your balance, of course, is $110. If you made $10 loss, your balance, of course, is $90. That's what it is. Equity, on the other hand, is like your floating balance. So if your balance is $100 and this $10 is floating, that means you've not closed the trade yet. It's already a minus 10. So what you'll be seeing in equity is $90. You have not closed it yet. It means if you leave it, it's either possible that it goes back to $100 and maybe goes higher, or it keeps going down till the point maybe where it becomes minus 50 and then If you close it at that point, your balance is $50. I hope we understand that. That's the difference between balance and equity. For equity, it is not your balance yet because you've not closed it. So it's neither profit or loss, it's just floating. So if you have analyzed and you see that it will still go up, you wait patiently and watch it till it goes up. If you see that it's not going to go up, you close your trade and accept your loss like that. So I think this is all for today. We've talked about a lot of things. This video is 30 minutes. I think this is going to be the longest video so far. I just hope this video helps us in understanding the basic Forex terminologies. So, teşekkürler, that is thank you in Turkish. Çok teşekkür ederim. Thank you very much. Gracias. See you guys in the very next class, signed by your tutor, L. Cypher. See you guys later.